Hey everyone, Russ here from Tactical Mortgage Solutions. This is just a quick demo or to show you an update or a release of a new product or tool inside of TMS called Tactical Penalty Forecasting. This tool is inside the home refinance strategy session. And once again, this product, this platform is meant for engagement. It's meant for engagement with clients. It's meant to help with conversion ratios, to help basically show Canadian consumers that we as mortgage brokers are more than just a rate offering. We are more strategic in our initiatives to help them and so forth. So I'll do a quick demo here, and then if anyone has any questions, please reach out, schedule some time for a further, more a deeper dive into it. So within the mortgage refinance breakdown is what you can do is add mortgages. Now inside the mortgages, what I've done is this will be a monoline situation or a monoline example. And what you can do is fill out all the current details of where a client is today. So in this situation here, we have a monoline lender. It's a fixed, it's a 3-year term. It comes from maturity in 2027. So you've got 27 months remaining in the term. And this section of TMS is mainly meant for midterm refinances. Doesn't make sense to restructure a mortgage midterm. Current interest rate is 5.49. We've got a $500,000 mortgage balance. Payments are $31.50. We have an amortization of 23 years, 4 months. So down here, what you'll see is that it does a look ahead of what the penalty will be over the next 6 months. Now, why did I do that? I did that because lenders have transition points. And you can see in this situation here is that for a fixed rate mortgage, the penalty is going to be an IRD or a 3-month interest penalty. As you can see, as we go down in month 26 currently is the IRD is higher than the 3 months of interest. But as you get down to a transition point of say 24 to 23, you can see this changes. So I put this in here essentially just to show clients that, in the future, things can change. And, payments, as rates decrease, penalties can increase. As rates increase, penalties will decrease. So in this case here, what you can do is show the transition point to clients, because that may help you plan with them, or at least they see you more of a strategic advisor. So in this case here, what I've had a lot of brokers ask me, or users of the product say, well, what if the rates drop? What if the rates increase? Can you give me something to show that? And in this situation here is what will come up is you'll have a comparison reinvestment rate. So right now it is comparing with 20, what do we have here? With 27 months remaining, we're comparing that to a 2-year fixed or 2-year reinvestment rate. So in here, what you can do is you can show clients, if you wait and rates continue to fall, you can just adjust this and it can give you an idea of how much that IRD will increase over time. And vice versa, if the rates end up going up, then what you can say is if the reinvestment rate goes up, then it'll bring your IRD down. So this is very important in helping clients make decisions moving forward. Now on the bank side, what I've done is similar situation is that you can head down to tactical penalty forecasting. And what you can look at is it'll bring up the existing posted rate. And I know that we sometimes have no idea when posted rates are going to change. So this could create some engagement with clients to say, well, maybe it's best to do it now, or maybe it's best to wait. So in this case here, if we drop the posted rate, then we can see how the IRD will increase. And vice versa, if the posted rates happen to go up, how much they'll go up as well, or how much the IRD will decrease. Now, if we put this into a live situation, then what we can essentially do is begin to show clients in this case here is that if we have a transition point coming up, and say we look at this right now, if we add on 500,000 and we add on a penalty of 12,548, we can show the client that at this point in time is looking at a variable rate mortgage based on the hypothetical drop in prime rate is we will be losing out a little bit on this, of course. So we can then create a situation where, well, what if we wait a little bit longer? Now, it does leave us vulnerable, of course, to rate increases and decreases. But if that is the case, then we're now sitting at more of a savings situation. So this is just some of the tactics and some of the ideas that we're relaying to clients so that you can be more strategic. We are more than just rate in this in this industry. And this is a way to show clients and do strategic initiatives. So if you have any questions, like further details, please let me know. Keep well.